Hello, everyone. Today is Wednesday, April 29th, and we are recording live. Today's show, we're talking about markets on edge, but consumers on fire, records, risk, and a spending spree. And in our Wealth Wisdom Corner, retiring debt before you do. So without further ado, we'll get started with markets in motion. All right. So markets were all over the place this week.
Yeah, and the Middle East backdrop is still heating up.
But here's the twist: markets barely flinched.
Yeah, and while sentiment just hit an all-time low, consumers are still spending like nothing's wrong.
Yeah, so we've got geopolitical tension rising, markets hitting records, oil surging, and consumers powering through it all. Buckle up. This week brings the Fed, GDP, and a monster lineup of earnings.
And this is Markets in Motion. Let's go.
All right. So, yeah, markets were mixed last week as investors tried to gauge what the Middle East ceasefire might mean for global risk. The S&P 500 rose 0.55%. The NASDAQ gained 1.5%, but the Dow slipped 0.44%. Overseas, the markets fell 2.75%. Early in the week, stocks stayed under pressure as tensions escalated and the Wednesday ceasefire deadline approached.
And then midweek, the momentum flipped. Markets opened higher after news of the ceasefire extension, and then a strong Q1 earnings helped push the S&P and the NASDAQ to a new all-time high. Oil surged above $100 a barrel, lifting energy names by adding pressure to the broader market.
Yeah, investors seem increasingly desensitized to the conflict's headlines, though. But the chip stocks kept ripping right on through. The SOX index, which is a measure of the chip stocks, has now risen for a record 17 straight days. And earnings remain strong as 81% of the S&P 500 companies have beaten expectations, with profit growth tracking 13.3% for the quarter.
hmm And then geopolitical risk is still front and center, though. So the U.S. ordered the Navy to fire on small Iranian attack boats, laid additional mines in the Strait of Hormuz. And the third U.S. aircraft is now deployed, the highest count in more than 20 years. Western officials say Iran's regime appears more politically stable and hardline, and the conflict is straining the U.S. weapons stockpile. And then energy markets remain tight, and the U.S. shale producers are hesitant to boost output.
Retirement shouldn't feel uncertain, it should feel intentional. The difference comes down to precise planning. From Social Security and pensions to investments and tax-efficient withdrawals, every decision shapes the reliability of your income. And when taxes are managed wisely, your money simply lasts longer. At Friar Financial, our dynamic retirement income strategy brings all the pieces together so you can enjoy a retirement that's not just secure, but rewarding.
All right, so stocks split in every direction this past week, and kind of as we get into our record risks and our spending spree. And now we kind of head into a massive week: the Fed decision, GDP, PCE, inflation, and earnings from Apple, Amazon, Alphabet, Microsoft, Meta, Visa, Coca-Cola, Berkshire, Exxon, the whole lineup. This is Finance Focus. Let's dive in. So, as we stated earlier, consumer sentiment dropped to an all-time low in April, driven by the inflation worries, concerns, and global tensions. But consumers are still spending. Retail sales jumped 1.7% in March, the strongest monthly gain in more than 3 years.
And corporate headlines this week paint a little bit of a mixed picture. Intel beat expectations and guided higher on AI-driven data center demand. SAP topped cloud revenue estimates, but flagged Iran-related risk. Meta plans to lay off 8,000 employees. Microsoft launched voluntary buyouts for 7% of its U.S. workforce. And even Nike is cutting forts. Tesla began Cybercab production, but analysts say the rollout is slower than expected. And Spirit Airlines is in financing talks with the U.S. government, and President Trump says he may buy the airline at the right price. Global economic pressures continue to build. China's exporters are raising prices as oil costs surge. German business morale fell to its lowest level since 2020, and private credit funds are facing valuation gaps and withdrawal pressures. So here's what we're watching this week: consumer confidence, durable goods, housing starts and permits, trade balance, retail and wholesale inventories, the Fed decision and Chair Powell's press conference, Q1 GDP, jobless claims, and PCE inflation. Earnings to watch this week. Verizon was on Monday. Tuesday was Visa, Coca-Cola, T-Mobile, Starbucks, Spotify. Today we've got Alphabet, Microsoft, Amazon, Meta, Qualcomm. Thursday we've got Apple, Eli Lilly, MasterCard, Caterpillar, Merck, and Amgen, and ConocoPhillips on Thursday. And Friday, Warren Buffett and Berkshire Hathaway report, as well as Exxon and Chevron. So, in this week's Wealth Wisdom Workshop, we're talking about practical steps to budgeting and paying off debt to retire with confidence. So, retirement should be a time of celebration, right? A moment to enjoy the rewards of decades of your hard work. But for many people, that excitement comes with a real question: how am I going to pay for everything? After years of relying on a steady paycheck, shifting to retirement income can feel a little overwhelming and uneasy, especially if you're carrying debt as well. The encouraging news is this: with the right mindset and a clear plan and a commitment to your budget, you can step into retirement with confidence. So today we're breaking down some practical, actionable steps to help you get there. All right, so step one, focus on your budget. So let's start with the foundation, which is your budget. You've probably heard the saying, anyone can retire whenever they want. It just depends on what they spend. That's not just a catchy line, it's the truth. Your spending determines your retirement timeline and your retirement lifestyle. For some people, retirement timing is a choice. For others, it's driven by health, job changes, or family needs. Either way, an understanding of your essential spending is crucial. So start by documenting everything and break your expenses into two categories: your fixed costs, which are housing, insurance, utilities, debt payments. Then you've got your discretionary spending, which is things like travel, hobbies, entertainment, and gifts. When you prioritize your essentials first and then allocate what's left over to what brings you joy, you create a retirement lifestyle that's both sustainable and fulfilling. And then I would say take that even a step further. And this needs to probably happen actually today, is dividing your spending into needs versus wants. And when we can actually curb that want and get contentment, we're able to kind of build and attack that debt a little bit faster. So next, we're going to review your debt obligation. So debt is one of the biggest sources of anxiety heading into retirement, but not all debt is the same, right? A mortgage may still offer some tax benefits, but high interest credit card debt, yeah, that's got to go. That's the kind you want to eliminate before or early in retirement. It's also important to think ahead. If you know you'll need a car in the next few years, plan for whether you'll finance it or buy it outright. Build those decisions into your retirement plan now. So when you understand your debt today, you can manage it tomorrow without sacrificing your peace of mind. Step three is account for your healthcare costs, because they account for a tremendous amount of spending. So healthcare is the single largest and least predictable expense in retirement. And it's the one area people underestimate the most. So review your Medicare options carefully. Parts A, B, D, Medigap, Medicare Advantage, and understand what each covers and what it doesn't cover. Unexpected medical events can derail even the strongest retirement plan. That's why long-term care insurance or a dedicated savings bucket can be a powerful layer of protection. When you plan for your healthcare costs up front, you protect your lifestyle and your legacy for the next generation. And finally, we want to optimize those income streams. So retirement income can come from Social Security, pensions, IRAs, 401ks, brokerage accounts, or a mix of them all. And you can kind of actually throw a health savings account in there as an income source, because it can be used to take care of some of these healthcare needs. And each one has their own different tax implications. So the goal isn't just to maximize what you earn, it's maximizing what you keep. So coordinating your income sources in a tax efficient way can extend the life of your portfolio. Run what if scenarios, helping you see how long your income lasts under different market conditions. That's one thing we constantly do, is we stress test our plans to make sure that they can survive the downturns. This helps you make smarter decisions about when to claim Social Security or tap your accounts. So why does working with a financial planner matter? Well, these strategies can feel overwhelming and complex to many people. And that's exactly why you shouldn't try and figure it out all alone. A financial professional can help you build a comprehensive plan, run scenarios, prepare for the unexpected, and show how your budget assets, debt, and income streams all work together. The result is understanding, confidence, and the freedom to focus on what retirement should truly be, enjoying your life. So when you understand your spending, manage your debt, prepare for healthcare costs, and optimize your income, you give yourself the greatest gift in retirement, and that's peace of mind and the ability to live the retirement that you want. So until next time, please follow us on for our Financials Financial Forum, and we'll talk to you next week. Thank you.